Welcome to another tutorial video. This time around, we're going to be discussing the concept of free cash flow. As with some of the others lately, this is a revised and updated version of a previous lesson in this channel. The reason we're updating this is because the old one was a little bit unclear and moved too quickly. Also, some accounting rules have changed, and so the definition and calculations for free cash flow are a little bit different now. The concept of free cash flow is not that difficult, but it can be tricky to calculate and use in real life, so we'll go through a few examples of it here. There are also some conflicting definitions of free cash flow, some industry-specific differences, and some differences between US-based and non-US based companies. And to make things even more confusing, there are also slightly different versions of free cash flow and slightly different variations. So we'll look at all those here and briefly address some of the key differences to be aware of. Once again, this tutorial will be on the longer side, so to respect your time, I'm going to show the timestamps for all the segments up here on screen. And so you can just skip around and jump to any of these timestamps to go to the relevant segment and to look at the part that you want to learn more about. Just go to any of these timestamps right now and you can skip around like that. Let's get started with part one and go into the calculations and basic meaning of free cash flow. Free cash flow is defined as a company's cash flow from operations minus its capital expenditures, or CapEx. For an example, let's go to Target's financial statements and see in Excel how to calculate this. So I have a simple operating model for Target with its historical financial statements and some projections up here on screen. Let's go down to their cash flow statement. We want to get the net cash provided by operating activities, in other words, cash flow from operations, and then their capital expenditures, or CapEx, right here. So I'll just enter this line below the cash flow statement and say free cash flow. This will be in millions, just like everything else. And to calculate it, we can go up and take our cash flow from operations and subtract the capital expenditures. And so like that, we have the company's free cash flow. Now the question is, it's easy to calculate for a company like Target, but what does this actually mean and why do we bother doing this? Free cash flow tells you how much cash a company is generating after paying for the cash cost of its funding, so the interest expense on its debt, for example, paying to maintain its capital assets, and paying for other items required to run the business, such as purchasing inventory for a retailer. And if you look at Target's statements, you can see all that. Because if you go to the income statement, we see this deduction for the net interest expense, in other words, the cash cost of funding their business with the capital they have raised. We get to net income at the bottom, and then cash flow from operations starts with net income. So we've already deducted the cost of funding the business from those funding sources. We have adjusted for these items like inventory that the company needs to purchase in advance. And then we've also subtracted capital expenditures, the cost of maintaining their capital assets, like all the retail stores and outlets that they have. One tricky part, though, is that for this definition to work, free cash flow must deduct the net interest expense, preferred dividends, taxes, and all the company's lease expenses. And under US GAAP, it usually does that, but under IFRS, you can run into some complications and difficulties here because the cash flow statement is sometimes set up differently. Now, generally speaking, you want a company's free cash flow to be positive and growing, because if free cash flow is negative, then it means the company must rely on outside funding to stay alive. Of course, you also need to ask why free cash flow is positive or negative. It's best if a company's free cash flow is growing because its sales are growing and it is becoming more efficient because its margins are increasing. It's not as good if a company's free cash flow is growing because it keeps cutting costs or reducing its CapEx spending. And it's a warning sign if a company's free cash flow is growing, but its sales are actually falling, or it's playing games with its working capital, its depreciation, its CapEx, or its non-core business activities. Because unlike some other metrics, free cash flow does include the impact of non-core business activities since it starts with net income at the top. Let's go to Target and see what we can say about free cash flow. I will calculate the growth rate first for each year and just change these to percentages. And so we can see in the projections, it is growing at a decent clip here, 26%, 16%, 4%, 15%. If we compare this to the company's revenue growth, the revenue growth in all these years is around 3 or 4%, and their operating margins are around 5 to 6%. So it seems like free cash flow is growing by more than its revenue, but they're both heading in the same direction. Their margins are also staying about the same. The next thing to look into here would be to see why free cash flow is growing by more than revenue. And we can look at that in a couple of different ways. We can look at CapEx as a percent of cash flow from operations. We can also look at it as a percent of revenue and just see what they're doing here. We can also look at the change in working capital as a percent of cash flow from operations and see if they are playing games here or anything like that. So for CapEx, let's just take this number and divide by cash flow from operations. For CapEx as a percent of revenue, we can do the same thing. And then for the change in working capital as a percent of cash flow from operations, and let's copy that over. So we can see here that CapEx as a percent of cash flow from operations and as a percent of revenue is declining here. We also see that the change in working capital as a percent of cash flow from operations is staying in about the same range in the future period, 2%, 1%, something pretty low. But overall, the conclusion here is that yes, the company's sales are growing and its free cash flow is also growing, which is good, but it looks like the reason why it's growing more quickly than revenue is because CapEx here is falling over time as a percent of cash flow from operations and also as a percent of revenue, which isn't necessarily good and could be a warning sign, though it depends a little bit on why that's happening. So overall, we'd say that the judgment here is not entirely positive for Target. I should actually write that its CapEx is falling a little bit. Its margins are staying about the same, its sales are growing, and its free cash flow is growing more quickly than sales, it seems, because of CapEx falling over time as the company becomes even more mature. That's a little bit about the calculations and basic meaning of free cash flow. Let's now look at some free cash flow variations. There are many variations here. There is just free cash flow by itself. There's levered free cash flow. There's unlevered free cash flow. There's free cash flow to equity and also free cash flow to firm. And there might be even more. The short version is that most of these metrics are similar in that they're going to be related to the company's cash flow from operations and CapEx in some way. The difference is that some of these will deduct the cost of the company's funding sources, so its net interest expense and preferred dividends, and its non-core business expenses and income, and some will factor in debt issuances and repayments, whereas other variations will not. So for example, unlevered free cash flow, which we have done a dedicated video on, it's also known as free cash flow to firm, and with this one, you modify free cash flow to exclude or add back the net interest expense, as well as preferred dividends and other income and expenses. And as I said, we have a dedicated tutorial to this one, so take a look at that. But essentially, it's a modified version of free cash flow that ignores the company's capital structure, and so it gives you a better idea of what the core business is worth, ignoring the cost of the company's funding from outside investors. It's widely used in the discounted cash flow or DCF analysis because this is really the best and most reliable way to value a company. Then there's levered free cash flow, which is also known as free cash flow to equity. It's similar to free cash flow by itself. So if we go down here and we take free cash flow to equity would be almost the same, but there's one difference, which is that with free cash flow to equity, we normally start with cash flow from operations, we subtract capital expenditures, and then we do something with the debt issuances and debt repayments. Now, some people will argue that you should factor in both of these and include issuances and repayments. Other people say you should only subtract the repayments, and then other people say that you should subtract only the required mandatory repayments and not the optional ones. So we come up with a few different ways to calculate this, but here are the rough numbers for Target here at the bottom of this Excel sheet. We don't like to use levered free cash flow because no one agrees on the exact definition, and it's not really that useful for anything. Unlevered free cash flow is much more useful in evaluation, and free cash flow by itself is better for quickly comparing and analyzing companies because there's less to calculate and no one really disagrees about the basic definition there. So we don't find levered free cash flow to be all that useful a metric, even though some people like to ask about it in interviews. Let's now turn our attention to some complications around free cash flow under IFRS for non-US based companies. Now, we have a whole lesson on the differences between US GAAP and IFRS, so you can refer to that for more on these, but in short, the first problem here is that many companies using IFRS have cash flow statements that do not start with net income. So cash flow from operations might not be the correct number. Specifically, the problem is that if cash flow from operations starts with something like pre-tax income, or with operating income, then it might not deduct the net interest expense, it might not deduct preferred dividends, it might not deduct the full lease expense of the company, and so you have to be really careful for issues like that. This is particularly a problem when you're comparing companies that follow US GAAP and ones that follow IFRS in the same set or same analysis. Another issue is that there is lease depreciation on the financial statements under IFRS for operating leases. So when you're adding back depreciation and amortization in the free cash flow calculation, as we did here for Target, you can see the depreciation and amortization add back. Normally this is fine. For US-based companies, you just add this back and it's fine. You don't really need to change anything. But under IFRS, you cannot add back the lease depreciation here because the idea is that you want free cash flow to deduct the full lease expense. And under IFRS, lease expense is split into depreciation and interest elements. So you need to search in the company's filings and find a separate disclosure, or you have to make some type of rough estimate based on what similar companies are spending or how they have split up their lease expense into interest and depreciation. Let's go to a specific example here. We'll look at Fortum, which is a Finnish energy company that operates in the Nordic and Baltic countries, Poland, Russia, and India. Now, if you go to their cash flow statement here, I pulled up their consolidated cash flow statement. Actually, the first part is fine because it starts with profit for the year, which is basically net income. So they've deducted the income tax expense. They have deducted the full lease expense here. They've deducted the net interest expense. They don't have preferred stock, but if they did, the preferred dividends would also be deducted here. So since this matches the net income on the company's income statement, let's go up and take a quick look at that. You can see here that profit for the year matches the very bottom line on their income statement. So this part is fine, and we don't need to make any adjustments here because it seems to deduct all the items that free cash flow should normally deduct. The problem is that depreciation and amortization here also includes a portion of the depreciation element of the company's lease expense. So we need to adjust by subtracting that portion. So in other words, when we go down here, and let's say we want to take the net cash from operating activities and say, okay, we're going to calculate free cash flow by taking this number and then by subtracting the capital expenditures. Yes, that's okay for a starting point here, but we have to go a bit beyond that because the depreciation and amortization that is listed right here, the 575, for example, includes a portion of the lease expense, which we do not want to add back. If you go further on in the filings, if you go to page 142 of their filings and you look at the amounts recognized in consolidated financial statements for their leases, they've split their lease expense into a depreciation and interest element. The depreciation element is 18 million. So we would have to go back here, and when calculating free cash flow for this company, we would take the net cash from operating activities, we'd subtract the capital expenditures, and then we would also subtract the 18 million for this most recent fiscal year. That 18 million represents part of the lease expense, which we do want to deduct in this metric. So in this case, it's not really a major adjustment or a major concern that we have to make, and it doesn't really make that much of an impact because the company's cash flow from operations is 2 billion euros. So it makes a small difference, but for certain companies, especially those with more substantial operating leases and lease expenses, it could be a lot more significant. Let's now go to part 4 and talk about a free cash flow analysis and look at Best Buy and Zendesk. Now, before we begin, I have to warn you, this is not a great example because Best Buy is a mature retailer. Zendesk, on the other hand, is a high-growth software company, so we don't really want to directly compare these two types of companies. It's not that meaningful. But these are going to be some more general comments to show you some of the issues that come up and some of the interpretations when you're looking at free cash flow in real life. So let's go over to our Excel file once again and go over to the FCF examples tab. And I will go here and calculate free cash flow for these companies. And then let's do the same thing here. And then down here, I have some metrics. We have the free cash flow growth rate for Best Buy. We have it for Zendesk. And we also have right above this, the revenue growth rate. We also look at items like capital expenditures as a percent of cash flow from operations. And we look at the change in working capital compared to the change in revenue and the percent of revenue as well. Now for Best Buy, if you look at their free cash flow, it drops going into year 1, but then in year 2 and 3, it grows and is positive, so that is a good sign. If you look at the growth rate here, it's growing at around 9 to 10% up to 15% in year 3. And then if you look at the revenue growth rate, revenue growth here is around 2%. So Yes, it's good that free cash flow and revenue are both growing, but the main question here is, again, why is free cash flow growing by a higher percentage than revenue? It looks like part of this might be explained by capital expenditures here. They're falling from 34% to 29% of cash flow from operations, so that could be one possible explanation here. The net change in working capital doesn't really seem to be contributing because it goes from positive in year 2 to negative in year 3, so that's not really propping things here up. So it's partially because of the lower CapEx here. We also think that the company's margins might be rising. We don't have their operating margins listed on this tab, but that could also explain part of this. So overall, it's not exactly negative here, but we'd say that it is slightly concerning that it seems to be driven in part by this 5 percentage point drop between CapEx as a percent of cash flow from operations in year 2 and year 3. Now, if we go over to Zendesk, free cash flow for them is also positive and growing, and also at quite different rates than revenue growth. Free cash flow is going from 4 to 26 to 43 to 50. So far, so good. If we look at the growth rates, 560%, 67%, then 15 or 16%. Now, revenue is also growing very quickly at close to 40% here, but free cash flow is clearly growing at a rate far above that. And if you look at the CapEx numbers here, it's actually increasing or staying in about the same range, about 44 or 45% as a percent of cash flow from operations. It doesn't seem like the change in working capital is contributing that much because it goes from 13 to 25 to only 5. So that can't really explain the increase in year 3 because the change in working capital here is actually decreasing. The real factor here is probably the company's high stock-based compensation add back. If you look at their financial statements and go to their cash flow statement, you can see right here that stock-based compensation is a massive amount. It is almost bigger than the company's net income in many of these years. So that completely offsets the company's negative net income right here. And that in large part explains why free cash flow, as it's traditionally defined, is actually positive and growing each year for Zendesk. Now, this brings up the point of whether or not we should even add back stock-based compensation in free cash flow, which is a whole separate discussion. For now, we'll leave it in, but just be aware that in many cases, when you're doing a DCF, you will actually leave this out and ignore it and count it as a cash expense. Our interpretation here is that the company isn't doing horribly. It's not bleeding cash quite as much as other high-growth software companies, but it's less sustainable than it initially appears because yes, it doesn't cost the company anything in cash terms here, but effectively what they're doing is diluting their existing shareholders and paying their employees in stock rather than cash so that their cash flow goes up in the current period, even though later on it'll cost them because their shares will be worth less to their current shareholders. The point is that with free cash flow, you really have to dig into the numbers and see why they're changing the way they are before you can make definitive statements about the company. We're at the end now, so let's do a recap and summary. The basic calculation for free cash flow is cash flow from operations minus capital expenditures. It tells you how much the company's business is generating after paying for its outside funding sources, the cash cost of those funding sources like interest expense on debt, also paying to maintain its capital assets in the form of capital expenditures, and then paying for its working capital requirements and for items like inventory that it needs to keep operating. It's best if free cash flow is positive and growing because the company's core business and their sales are growing. It is not as good if free cash flow is growing because the company is cutting CapEx or cutting its spending, or if free cash flow is moving up even as revenue growth and operating margins, operating profits are moving down, for example. There are some other variations like unlevered free cash flow and levered free cash flow. Unlevered free cash flow excludes net interest expense and preferred dividends and non-core business income and expenses. Levered free cash flow is similar to free cash flow, but it also factors in debt issuances and repayments. Unlevered free cash flow is very useful in a DCF and valuation. Levered free cash flow isn't useful for too much at all. Under IFRS, you have to be careful because many companies will start their cash flow statements with something other than net income. Fordham did not do it here, but you will run into that in many cases, so you may need to adjust for that. Also, with depreciation and amortization, this will include lease depreciation under IFRS, so you will need to subtract that when you make these calculations. And then finally, we saw what these numbers look like for Best Buy and Zendesk and how both companies seem fine on a free cash flow basis, but once you dig into the numbers, you see some reasons to be concerned. With Best Buy, for example, it seems like since free cash flow is growing far more quickly than revenue growth, part of it is explained by falling CapEx, which is usually not a good sign. Part of it might be explained by changing margins. And then with Zendesk, the issue here is that, yes, it's good that both revenue and free cash flow are growing, but it's being propped up by this huge stock-based compensation expense that they're adding back, which really should be viewed as a form of financing for this company. So the company's business is less sustainable than it appears at first glance. That's it for this lesson. Hopefully now you know a little bit more about free cash flow and how to calculate it and use it in real life.